Yes, we are back, my friend. You know what that music means? It's Let Me Explain with Chris. Welcome to the show, my friend.
Gentlemen, good to see you again.
Good to see you. Good to see
It's an
Tom.
exciting morning. It's an exciting morning. Tommy DeVito, the New York Giants.
Oh, look at you, a Giant fan all of a sudden. No.
It's turning into the Jersey Shore.
You don't
now,
get to cross
over there.
over. You don't get to cross over all of a sudden. You can't jump on the bandwagon. Okay, you are a miserable, suffering Jet fan, and you should just, that's where you've got to stay.
Stay in your lane is what
You
he's
got to stay in your lane.
saying.
You can't jump across the bridge. You can't go across the line. Giant fans are suffering too. They need somebody to somebody to
lift their spirits.
Yeah. It's a good story.
It's a great story. The guy's living at home. His agent looks like he's straight from The Sopranos. I don't know if you saw the images of him on the sidelines.
Yeah, everybody's seen it.
I like the fact that the Giants played the Sopranos music when he came out of the tunnel. That was good.
Yeah.
But they stink. I mean, the Giants just stink. It's amazing they could win any games with that team.
It's Zach Wilson and Tommy DeVito are not the future of New York football. So we'll see what happens. But hey, 2% chance that the Giants make the playoffs. We got to hang our hat on something.
Yeah, I give that two. Yeah, that. But hey, dare to dream. Hey, Bears had the Tyson Bagent, so we've been down that same path. You know what that ding was, Tony? Oracle, we're out.
Oh,
for
good
a profit.
Good job out of you.
Shocking.
Very nice. Even though Oracle was down $11-12 on the opening, what's it doing right now?
$11.75.
Beautiful. Good job.
That's what happens. You roll the calls down, neutralize the whole position, salvage that little pig lotto.
Mm-hmm. Good job.
Yeah, one stock.
What can't you do? Chris, help me out here. What can't Tom Southen up to?
I can't do a lot of
Don't
other
answer
stuff.
this, Chris. It's a trick question.
I was going to say he can do everything.
There you go.
Yeah, no. Be careful. I don't know if you have anything on in Moderna, but it's approaching that downside kind of 75 level. Anyway, what do you got today, Mr. Vecchio?
Well, it's one of those days of the month that we talk about, the inflation report. The November U.S. inflation report came out today, the last inflation report that we'll see in this calendar year, and it came in just a smidge hotter than expected. The month over month was 0.1% versus 0% expected, but the headline was right on the screws at 3.1%. The core readings were right on the screws, both in the month over month and year over year, and the market reacted meaningfully. Well, I don't even know you call it meaningfully given what we saw last time, but we did soften up a little bit here. Yields did push higher, stock indexes did come off in the pre-market trading, and this really could be the day, the entirety of the price action today, because we are now staring down the pipeline at the Federal Reserve meeting tomorrow. Now, what does the inflation report tell us about what the Fed may say and how they could inject some volatility into this market? Quite frankly, nothing. And I say that not because I don't find the data interesting. This is something that I look forward to seeing every single month, but because it's evolving in a manner consistent with what the Fed has expected and what the market expected. The biggest contributors to headline inflation were used car prices and housing over the past month, but we know that housing is delayed. The official owner's equivalent rent is based on a survey of how people believe they could rent out their homes without utilities or any furnishings. And that typically lags private sector indicators like what you see from the apartmentlist.com or Zillow or Redfin national home price indexes by about 12 months. And those have been mired in downtrends and in negative territory. So is it really worth getting worked up over the rise in shelter? No. What about used car prices? Well, last month we did see, of course, that we were just coming out of the UAW strikes. Those added about 28,000 jobs back to the non-farm payrolls because the BLS does not include striking workers on payrolls when it does its computation. And so there's a little bit of hiccup in production. Not a surprise. So is it really worth getting worked up over? I don't necessarily think so. But the fact of the matter is that when you look through the data series itself, the base effects that come into play for December dictate that you're probably going to see a rise in inflation once more. And that means the Federal Reserve tomorrow, despite the markets chirping and howling that rate cuts need to come as early as March 2024, we're probably not going to hear that from Fed Chair Powell when he takes the podium at 2:30 p.m. Eastern. So what does this all mean? What does this mean for market volatility? What does this mean for the outlook for this week? Quite frankly, a lot of good two-way price action, But in terms of big directional moves, like what we saw after the October CPI report released on November 14th, or even the Fed meeting last month on November 1st, I think we can downgrade the assessment of seeing significant price swings. Chair Powell's going to take a measured neutral tone. They're going to add some rate cuts back on the board, but not as many as the market wants. All in all, it brings us through this macro storm of what was NFP, CPI, the FOMC in the span of 3 of 5 trading days, Friday through tomorrow. Actually, 3 of 4 trading days, Friday through tomorrow. Probably comes and goes without much of a kerfuffle. Tom, if you look at the volatility that's priced into the end of this week, if you look at the ES options chain on the tastytrade platform, you're not seeing much significant movement. Basically, 1% through the end of this week. It's not like what we saw at earlier Fed meetings this year, and quite frankly, it probably means that this is an event that people could overlook if they have better things to do tomorrow at 2 p.m. Like, I don't know, listen to Truth or Skepticism with Radigan and Sosnoff.
And not have to switch back and forth to see what the market's doing.
Yeah, essentially, what is Friday is the 15th, right? Yeah. It's
all day.
1% move in the SPX.
That's what the gentleman said prior, yes. But
I
now
understand.
that Tom Sosnoff confirmed it, it becomes truth.
Yes. Well, I was just, that ding was my SPX trade.
I know, and I know the number you were asking for. That ding, Chris, was Tom scalping his SPX trade, which took 11 minutes. The number he's looking for is 11 minutes. How long did it take him to make $1 or so?
We're just testing a strategy that's
The
worked
research
6
team
days
has been
worked
looking
6
at.
days in a row, so we're having a little fun with it. Anyway, so I listened to the little discussion you gave here, and all sounds so eloquent, but
Unlike us.
yeah, but I agree. There's no reason for. First of all, there's no reason for the Fed. The Fed got bailed out. So when you get bailed out, you don't kick a gift horse in the mouth type thing. All right. It's just the Fed got bailed out by the bonds rallying from 107 to 120, and for short-term rates coming down a little bit, and which takes all the pressure off mortgage rates, which takes all the pressure off inflation. So now you have essentially what is a perfect storm. You have enough interest rates to satisfy those that want decent risk-free rates, and you have a happy place in the middle so that there's not too much pressure on the bond market, and everybody is happy because it's a perfect storm. And so it makes zero sense, for the Fed to do anything except accept this as a gift from the gods, and which is what I think they're going to do. So the way I look at this is just different from most in that I don't look at this as if it is Fed inspired or Fed driven. I look at this whole thing as if the market just gave the Fed a Christmas present. It's a big giant Christmas present. They wrapped it up in a bow. If interest rates, if bond yields had approached prices had approached 100 as this year kind of wound down, the Fed would be basically a gun to their head, at a 7% long-term, 7% long-term rate. But it didn't happen. We had a really nice rally. We came back, 10% or whatever, at least 10%. And all of a sudden, you're in this perfect spot where, bulls are happy. People looking for risk-free returns are happy. People that are borrowing are happy. Everybody, this is the perfect place. All the risks just came off. So the Fed's not going to do anything except it's going to be a happy speech. Because why would you disrupt anything when you're kind of, you're 3 steps from your house. You don't want to get into an accident. So you're done. So I think that is the easiest story here.
But most accidents happen around the
doesn't matter.
The home.
You're done. You're home. I think that's all bullshit anyway, too.
No, you spend most of your time around your home.
No, I know, but I think the fact that, like fender benders maybe, but,
Most car accidents happen within a mile of the home. That's true.
Yeah.
Yeah, I don't believe that stat. That's always been like some garbage stat. Fender benders. It's a fender bender. Like most people.
Right. You're only a little pregnant. I got it. It's not an accident. I got
You
it.
don't get your car totaled a block from your house.
Says Tom Sosnoff.
Okay. Anyway, point here is It's the perfect storm, and that's it. And I don't think this has anything to do with the Fed. They just have to take it and say, hey, thank you very much, market, and move on to 2024, and go in with kind of like, you're in a perfect position politically, because you've got no pressure from the current administration, and you've got no pressure, in whatever role politics will play in the election kind of proceedings going forward. So I think it's a perfect world for the Fed, and this gives them a clean slate to do whatever they want to do in 2024.
I would agree. The opening for tomorrow for some volatility is the fact that the market's still pricing in 5+ cuts for next year, which feasibly, if the Fed starts cutting in March, I don't know how that works out. The Fed does not like to change interest rates 2 months prior to an election, which effectively takes the September and November Fed meetings off the board as potential, event horizons for when you could see rate cuts. And if they're starting in March, that's March, May, June, July, potentially, and then December as the 5th meeting, because if you're taking January, September, November off the board, there are only 8 Fed meetings a year. So I think that maybe you're going to see a little bit of a hawkish twist there. And we've seen how, as you said, the market's done the Fed's work for them. There's been this debate that Ilya, Dylan, and I have been having about whether or not the Fed leads rates or rates lead the Fed. I think the Fed does some sort of signaling. They tell us what they intend on doing with policy, but it's what the bond market ultimately leads the Fed to doing. You can just look up the Fed funds chart versus the 2-year yield. You'll see that when Fed funds go up, it's usually preceded by 2-year yields going up. And when the Fed funds rate comes down, it's because 2-year yields have already made their move lower. And we've seen that move lower here in recent weeks. We're about 40 basis points off the highs. That's effectively 2 cuts that have been given to the Fed by the market already. And so the Fed, as you say, has no real reason to upset the apple cart right now. It has everything where it wants it. I guess the bigger question, though, is on the other side of what's perceived to be a low volatility event that puts us into the wheelhouse of what is triple witching next week. Index options expiring, index futures expiring, just single equity options expiring along the way. The second half of the month of December, if you are looking for gains historically, has been the better part of the month. Plain and simple. 5-10-year seasonality hasn't been that good for December, but the longer you go back in time, 15, 25, 50 years, December gets better the more data that you add to your sample size. And it's consistent across the board that the second half of December has been the better part of the month, even in losing years. So if we can kind of make our way through the mire here, if we can get around what's been an intense macro few days, we can get through the triple witching, going unscathed, then this is a market that going through the holiday season ultimately could continue to scratch and claw its way to the upside, barring some external shock, which the market's been absorbing pretty well right now. I mean, we benchmarked the Israel-Hamas war. These attacks by the Yemeni Houthis on various commercial vessels in the Red Sea don't seem to be bothering the energy market, don't seem to be bothering the precious metals market, the places where you look for any sort of geopolitical risk premia coming back onto the table. There's not really much getting in the way right now of this market continuing to just grind and claw its way higher. So the next week matters, of course, but once we get through the storm, who's to say that we're not going to see the continued float to the upside in bonds as well as in these equity markets to close out the year, which, by the way, if you look at ESH4, NQH4, we're sitting at the yearly highs in some of these contracts right now. Dow Jones has been on fire recently. You can't discount that either.
No, I don't discount any of it, except that when you get to I don't discount any of that, but when you get to a level like we're at right now in the equity indexes, and you have really low implied volatility, and you're at record highs, and it looks like it's just a daily churn, and like one day they buy Microsoft, the next day they sell it. One day they buy Nvidia, the next day they sell it. It's the same thing. I don't read anything into that. It's just the market's just churning around, and it's everybody just playing. Everybody's playing games. It's okay. That's what happens at the end of the year. Everybody plays games, and when there's no real pronounced trend or anything like that. And I think that this is just kind of typical. As for triple witching, like you said to start off the discussion, there's a 1% move built into the next 3 days.
That's what volatility's telling you.
Yeah, there's it's not much on the triple witching side. There's literally not much there.
But you had a little blip in bond volatility with the CPI number.
Yeah, all the I just looked at all the yields. The yield curve is I mean, the 10s are down today yield-wise. The 10s are lower, the 2s are higher. That inversion has really widened out this morning. It's actually kind of interesting to me here. I kind of want to buy 10-year yields and sell 2-year yields because that thing's out to, where is it right now? 50, basically, 50 basis, 5. What am I saying?
I have negative 49.7 basis points.
Yeah, I was going to say it's right around
50.
50 basis points.
Right.
Yeah.
It's got as high as a full point, right?
Yeah,
almost
way
back
back
to even.
when. But it's up to 50 basis points right now. So I got it on small. I'm going to probably add to my position today because I think at 50 basis points, it's an interesting trade for 2024. I kind of like it. I don't think it's going to stay there at 50 basis points. I think the risk reward is pretty good in that trade. So yeah, I'm gonna trade the.
You think it'll stay at 50 basis points? You're going to go down to $1?
I think it's going to contract.
Just kidding.
Yeah, I think it's going to contract. I think it goes back down to 25 or 30 basis points. So we'll see. Other than that, I don't have much with yields. I don't think there's, we're short bond premium. We're short note premium.
Nasdaq just turned green, up 17.
Yeah, I'm watching it. I got a screen, as they say.
But Tom, that's really like the trade, I think, and this is something that I wrote about for Luckbox and for the trade ideas for 2024. If bond vol spikes and yields move up, it's going back to what you said earlier. Don't look a gift horse in the mouth.
Yeah,
it's
bond
the opportunities.
Bond vol's not going to spike next year, though. Bond vol's been rich all of 2023. I don't see bond vol being rich. I think bond vol is a sale no matter what. I don't think bond vol goes anywhere next year. So I don't think bond vol. I think if you're going to be short bond volatility, you had to be shorted in 2023. I think in 2024 it's going to get cheap. It's going to sit there. It's going to be a crappy trade. There's still some trade there now. I think the yield curve trade is going to be good, but I don't think bond vol is going to be good. It's starting to dry up a little bit, and I think I can see bonds staying right here. All right, what else you got? Other than Fed talk.
We're at the top of the hour, so I think the last thing to mention is keep an eye on what's happening in energy markets. There is some premium in there. Crude oil's off $2.50 today, but the whole concept is if you're in the zone between like 66 up to 70 and you have this elevated volatility situation, looking at selling short-dated put spreads, very feasible right now, at least in the very short term. We know that the Biden administration is supporting the SPR down at these levels. They've told us that they are going to continually refill the SPR between $67 and $72 a barrel. OPEC obviously is a non-factor right now, but oil, gold, and maybe a little bit the long end of the curve. That's where the volatility is in this market. If you're looking at equities, you got to pay attention to the Russell more than anything else, because I'm looking at IVRs in the single digits in ES and NQ, and you're still looking at something 25 to 28 in RTY. So other than that, gentlemen, this is a pretty staid, tepid macro storm that we've made our way through, which I know disappoints you guys, both being such adamant Fed lovers.
Yeah.
Thank you, my man.
I mean, I think you're right about the Russell. It's the only place, and it is a really, just for trading IWM, it's a really liquid option market. I don't love RUT, and I don't love /RTY for trading options, but I've been carrying a Russell position, and it's actually been quite nice. I think I have to get out of some other positions and move more capital into Russell, because it's been the only thing I think you get hung up on in Russell after trading it a lot is, because I kind of trade it every day, is you there's not a lot of juice out. It doesn't have like kind of the wings that you have in the SPY or in the QQQ. You're really tight no matter what in the Russell. So no matter where you go, you're tight. Like you're not going out to get, if you go out to get a $2 or $3 option, you're wrapped around the money. Like you're not going that far out of the money. So so the risk of the Russell is just a pop and vol, but it's still better than SPY and NASDAQ.
Agree with you there.
Yeah, you just got to be careful, because people think like, oh, I can get really wide in here. You can't get that wide. And if you're doing iron condors, it's even harder.
Yeah, it's a small credit.
Yeah, it's a small credit. But if you're doing naked options, it's okay. But remember, right now, the IV rank in the Russell's 22, 23, which is pretty good. But implied volatility in there, it's only 20.
Right. NASDAQ is 2. NASDAQ and even the S&Ps are 4. I mean,
Yeah. No, there's nothing in there. Right. And the implied volatility is, significantly lower. 20 in the Russell, it's half of what it was, 3 months ago. So he's got to realize that's where the risk is.
Very good, sir. Thank you so much for your time, Chris. We're going to take a quick 90-second break and come back. We got a market measure next. This is Tasty Live.